Good morning. This is Dylan Jovine with Behind the Markets. Happy Friday. Today is Friday, September 26th. Thank God it's Friday. TGIF. Made it through another week. We're trudging through the week. Last Friday in September. Anyway, today I'd like to talk a little bit about what the Fed's recent interest rate decision, lowering rates by a quarter point, means for the economy. And I got the idea. I was sitting there on the phone talking to a buddy of mine about it. My son Teddy looked at me and said, "What are interest rates?" And I started to talk to him about the Federal Reserve and mortgage rates, and his eyes glazed over because he's 10. So I figured his eyes may glaze over, but your eyes may not glaze over. So I figured I'd discuss what the quarter point reduction in interest actually means to you and me. So let's talk about it. Mortgage rates. How does the Fed lowering rates help the economy, help us? Let's start with mortgage rates. Mortgage rates really aren't tied to the prime rate, the Fed funds rate. So I don't bet on any major drops soon. They're really tied to the 10-year bond, the 10-year yield that we talk about here all the time. And those yields are basically driven by economic expectations, the economy, debt, all these other things. And the average rate on a standard 30-year mortgage right now has drifted down to about 6.26%, basically because the economy's gotten weaker. But the figure isn't really expected to veer far between 6 and 7%, that range. And even the Mortgage Bankers Association said they expect that to be stuck at around 6.5% by the end of the year. It doesn't really, again, Fed lowers rates, it's not going to really affect the mortgages. All right, credit card rates are tied to the prime rate, which is tied to the Fed's benchmark rate. So once the Fed cuts rates, cardholders typically see their interest rates adjusted within 60 days or about 2 billing cycles. But look, the average credit card balance is about, what was it, $6,473 with a 22% rate. So a quarter point cut in the Fed rate is going to lower the monthly payment by about $1. So I wouldn't go happy days are here again. It's $1. And any young people out there listening to this, I know we have some young customers. Credit card debt will kill you. It really will kill you. All right, car loans. Yes, car loans are impacted by the Federal Reserve short-term rates, specifically the Fed funds rates. But it's not a one-to-one correlation. I remember, you go get a car loan, there are a few factors involved. One is that, the short-term rates. It's also what your credit score is, what kind of car it is, all these other things. The average rate on a new car loan has been virtually unchanged at about 7%, and the used car down has been about 10.7%. It's weird to me that's the case, but that is the case. And let's face it, car prices have just gone bonkers since the pandemic. So I don't really expect, certainly not a quarter point drop, to really have a big impact on car loans either. Savings accounts, we'll touch on that one, the last of these four that I wanted to talk about. Savings account, how does the Fed funds rate impact savings account? We learned when the Fed started raising rates, the banks did not really raise them as quickly. We all know that. The banks were real slow to start paying us more money. And you know what? Surprise, they're slow on both sides of it, but they're a lot faster when it comes to cutting the amount they pay you. Surprise, it's amazing. Oddly enough, a lot of banks are paying decent rates finally. It took them a couple of years to catch up. And they pulled in a lot of cash. So they might not be, especially with the Fed saying that we're not clear how many more cuts we're going to be doing through this cycle. So I'm not sure that the banks are going to really be dropping their savings rate very quickly. I think it's going to be based on each individual bank, because if they do, their competitors who happen to just stay the same or even raise the amount they pay, they're going to suck in a lot more capital. They're going to suck in a lot more capital because people like me will say to you, this bank pays more than that bank, et cetera, et cetera. So you might want to put your money there, or this CD pays more than that CD. And they try to lock you into these CDs so that they can take the money that you put into those CDs and then invest them, turn them around and lend them to higher return activities, maybe corporate debt or whatever it is, something that gives them higher returns for the amount than what they're paying you on that CD. So anyway, I just thought this would be a good time to actually explain to folks how the Fed's rate impacts your wallet. This is not a personal finance channel, but it is very important for all of us. We are all in our own business of managing our finances. But as investors, remember the short-term rate isn't the one we focus on more here at Behind the Markets. We focus on the 10-year. The 10-year is the one that really drives the stock market. The stock market has gone higher, you'll notice, because the 10-year rate has gone down. Remember, every time it was hitting 5, the market was like frozen. It couldn't go above that. But it drifted down to 4. If we see a burst in economic activity, if those job numbers start to grow again, you can see that rate pop up back to 5 and the stock market get hammered. That's a problem for another day. That is not a problem for today. And when we run into that problem, we will handle it with the same cool that we handle all of our problems. Anyway, that's all I have. Have a wonderful weekend. I will speak to you on Monday.